First quarter fiscal year 2027 for Deckers brands, Q1 revenue hit $1.02 billion, which is up 5.7% year over year.
And diluted EPS came in at 94 cents.
Right, edging out last year's 93 cents. They also raised full-year FY27 diluted EPS guidance by 5 cents. So that's now sitting at a range of 7.35 to 7.50.
Yeah, while net sales guidance is held firm at $5.86 billion to $5.91 billion.
Which is fascinating because, crossing that $1 billion revenue mark for a first quarter, that's a first-time milestone for Deckers.
It really is. I mean, in the retail, apparel, and footwear space, putting up a 10-figure top line right out of the gate is just a massive statement.
Oh, totally.
Because the first quarter is rarely the heavy hitter for seasonal brands, right? So crossing that threshold, it sets a very specific tone for the rest of their fiscal year.
It's like a track athlete hitting a personal best in the very first heat of the season. You're not even in the finals yet, but you just set an incredibly aggressive pace.
Yeah.
And it forces you to look under the hood. You don't hit $1 billion by accident, right? When you open up the segment breakdown in this report, there's a very clear divergence happening.
Yeah, it's basically a two-engine machine right now, but those engines are running at vastly different speeds.
HOK is doing the heavy lifting, obviously.
Always. I mean, net sales for HOK were up 7.7% to $703.5 million. And management reiterated that they expect HOK to grow by a low double-digit percentage for the full year.
Okay, and then you've got UGG.
Bro, UGG is just holding steady. Net sales were up 4.9% to $278 million. They're expecting mid-single-digit growth there. But the real contrast, it pops up when you look at the other brands category.
Yeah, that dropped sharply, down to 18.1% to $37.9 million.
Exactly. And the report specifically calls out that this decline is due to phasing out the Koolaburra brand's standalone operations.
I was looking at that Koolaburra phase out, and, well, it feels like a strategic amputation.
That's a good way to put it.
Because Koolaburra was their value tier offering, right? It was originally meant to capture the consumer who maybe couldn't stomach the price of a premium UGG boot.
Right, the lower price point.
Yeah. But phasing out its standalone operations tells me management is entirely focused on just clearing the deck. They're removing distractions to focus on the premium heat of HOKA and UGG.
That is the exact strategic shift taking place here. Maintaining a lower tier brand, it requires a completely different operational playbook.
Different marketing entirely.
Exactly. Different marketing, different retail partners, and usually a tolerance for much lower margins. So by fading Koolaburra out of the spotlight, Deckers is signaling a total commitment to premium positioning. They're protecting their pricing power.
I do have to push back a little on the HOKA narrative, though.
Okay, let's hear it.
So if HOK had just pulled in over $703 million out of a $1.02 billion quarter, that means HOK is roughly 70% of total revenue.
Yep, the lion's share.
But they only grew at 7.7% this quarter. For a brand that's been known for this explosive, hyper growth over the last few years, a single-digit quarterly growth rate makes me wonder.
You're wondering if the sprint is over.
Exactly. Are we seeing HOK transition from that explosive growth phase into a much more mature marathon pace?
Well, I mean, when a single brand commands 70% of a billion-dollar pie, maintaining 30 or 40% growth becomes mathematically grueling.
It's just the law of large numbers.
Precisely. But CEO Stefano Carotti's commentary gives us some necessary context here. He attributes this quarter's performance to compelling product innovation and expanding global reach.
Rather than just flooding the market with inventory.
Exactly. They aren't just selling the exact same running shoe to the exact same hardcore marathoner over and over.
They're trying to widen the funnel.
They have to. The strategy is moving from the hardcore runner into lifestyle, walking, everyday fashion while keeping that premium aura intact.
Which is a tough balance to strike.
It really is. A lot of footwear brands fall into the trap of chasing short-term volume. They get popular, they start selling to every discount retailer under the sun to keep the growth numbers looking exponential.
And suddenly the brand loses its cool factor.
Right. But Deckers is executing a highly disciplined long-term strategy. They seem totally comfortable settling into a low double-digit growth marathon for HOKO because the quality of that growth, the profitability, and the brand equity is incredibly high.
But keeping that premium price point is almost impossible if you're just handing your shoes off to discount department stores, right?
Yeah.
Because they might mark them down just to clear their own shelves.
Exactly. Which explains the massive deliberate shift we're seeing in their sales channels. Knowing what they're selling naturally leads to where and how they're selling it.
Yeah, the channel dynamics in this report are wild. Direct consumer, or DTC, is undeniably the star of the show right now.
Oh, for sure. DTC net sales jumped 13% to $352.8 million.
And even comparable DTC net sales were up 6.8%.
Right. Meanwhile, wholesale is lagging far behind. It only increased 2.2% to $606.7 million.
Now, they do note that the wholesale number is dragged down a bit by that Koolyburra phase-out, but the gap between 13% DTC growth and 2.2% wholesale growth is still massive.
It's a canyon.
So I look at that 2.2% and I have to ask, does that imply wholesale is slowly becoming a dying channel for Deckers? Or is management intentionally starving their wholesale partners to capture better margins for themselves in DTC?
It's rarely a case of intentionally starving wholesale partners because, those partners still provide incredible volume and visibility for the brand.
Sure.
But it is absolutely a case of intentionally prioritizing DTC. This ties directly back to Karate's stated goal of building deeper connections with consumers.
Because DTC gives them total ownership of the customer data.
And the brand experience. You know exactly who bought the shoe, when they bought it, what size they wear, and how to market the next pair directly to their inbox without a middleman filtering the message.
Plus, you control the physical presentation.
Exactly. When you walk into a wholesale partner's store, a pair of HOKs might be sitting on a messy shelf next to 5 competing brands.
But when you buy through their DTC channels, their own website or physical stores, the presentation is immaculate.
The premium halo is protected.
And that level of control seems critical when you look at their geographical split. The geography numbers this quarter are pretty striking.
They really are. Domestic net sales grew 3.2% to $517.4 million, but international sales surged 8.4% to $502.1 million.
International is almost perfectly at parity with domestic sales right now.
And that parity is exactly why leading with BTC is so vital for their global expansion. When you're growing internationally at an 8.4% clip, relying entirely on foreign wholesale partners means you lose control of how your premium brand translates across different cultures.
Right, different retail environments.
Exactly. By leading with DTC internationally, Deckers ensures that a consumer in Tokyo or London gets the exact same premium HOKA or UDG experience as a consumer in California.
They're building a global foundation on their own terms.
Exactly.
But pulling out of wholesale to do DTC is kind of like deciding to stop renting an apartment and buying a house. Yes, you stop paying rent to the landlord in this case. You stop giving away a slice of your margin to the retailer.
Right, you keep the whole dollar.
Which makes your gross margin go up. But suddenly, when the roof leaks or the plumbing breaks, you pay for it. You take on all the maintenance costs yourself.
And we see that dynamic perfectly reflected in the margins and expenses this quarter. You really have to dig into the income statement here because the surface numbers hide some complex mechanics regarding those maintenance costs.
Yeah, I was looking at their margin profile, and it feels a bit contradictory at first glance. The gross margin improved to 56.4%, up from 55.8% last year.
And management expects the full-year gross margin to be slightly better than 56.5% now.
Right. They also expect the operating margin to be slightly better than 21.5%. And I mean, a 56.4% gross margin in the footwear business is incredibly robust. You're keeping a lot of money from every shoe sold.
But here's the catch. Operating income actually dropped in Q1.
Yeah, it fell to $155.3 million from $165.3 million last year.
And the culprit is entirely found in their SG&A selling, general, and administrative expenses.
SG&A ballooned to $419.9 million compared to $372.6 million last year. So let me get this straight. They made more top-line money, they have significantly better gross margins, but their operating income shrank because they spent almost $50 million more on SG&A.
Yep.
Is this just the hidden tax of their DTC strategy? Are they burning cash on marketing and infrastructure just to fuel that DTC growth?
It's the ultimate double-edged sword of a direct-to-consumer pivot. When you pull away from wholesale, you boost your gross margin like we discussed.
Right.
But you take on all the costs of acquiring and servicing that customer yourself. You're paying for the digital ad campaigns to get them to the website. You're paying for the massive e-commerce server infrastructure.
And the returns.
Oh, yeah. The reverse logistics, which is basically a polite way of saying you eat the cost when someone returns a shoe that doesn't fit.
Plus, signing leases for physical retail stores and paying the staff to run them.
Exactly. That all lands heavily in SG&A. So,
yeah.
Yes, they are spending tens of millions of dollars extra to build those deeper connections and own that customer data.
That feels like a dangerous game if the top-line growth ever slows down, though.
How so?
Well, when you rely on wholesale, your costs are somewhat variable.
Hmm.
If you don't sell shoes to the department store, you don't pay the costs associated with it.
Right.
But when you build your own massive DTC infrastructure, you're locked into fixed overhead. You still have to pay the store leases and the e-commerce hosting fees, even if consumer demand dips.
It absolutely carries risk. You are increasing the operating leverage of the business, but management clearly feels confident they can absorb those costs.
And to understand why, you have to look at how they're engineering their earnings per share. Their
Yes.
incredibly aggressive capital allocation strategy.
You're talking about the stock buying spree.
Exactly. That raised EPS guidance up 5 cents to a range of 7.35 to 7.50 is heavily supported by their share buyback strategy. During the first quarter alone, Deckers repurchased 3.3 million shares for $338.2 million.
That breaks down to an average price of $103.79 a share.
And they still have a staggering $4.7 billion left under their stock repurchase authorization.
Just think about that. $4.7 billion essentially sitting in a war chest, waiting to be deployed to buy their own stock.
Which raises a crucial detail hidden deep in the Outlook section of this report. The EPS guidance they provided doesn't just hope they might do some buyback.
Right, it actively assumes them.
The report explicitly states that their EPS guidance assumes the repurchase of shares with a value equal to approximately 80% of projected fiscal year 2027 free cash flow.
Yeah, and think about the mechanics of what that means for you as an investor analyzing this stock. Think of a company's total profit as a pizza.
Okay, I like pizza.
If operating income is flat, or even slightly down like we saw this quarter, the pizza isn't getting any bigger. But by using their cash to buy back 3.3 million shares, they are essentially kicking people out of the room.
So the pizza is the exact same size, but your individual slice just got bigger?
Precisely. That is how they can raise EPS guidance without necessarily raising their operating income right now. By shrinking the denominator, the number of shares outstanding they were out, they can grow the earnings per share, even if operating income faces short-term pressure from those heavy DTC investments.
It's financial engineering, pure and simple.
It is?
But it's financial engineering backed by an absolute fortress of a balance sheet. I mean, look at these numbers. They ended the quarter with 0 outstanding borrowings. None.
Yeah, that's rare.
And they have $1.603 billion in cash equivalents just sitting there. But here is the operational detail I find most impressive. Inventories actually fell to $807.6 million, down from $849.4 million last year. Sales went up 5.7%, but inventory went down.
That inventory metric might be the healthiest number in the entire earnings report. In the apparel and footwear industry, excess inventory is a death knell.
We've seen it happen.
We've seen major competitors in the sportswear space get absolutely crushed over the last 2 years because they over-ordered inventory during the supply chain panics.
Right, and when you have too much inventory, you eventually have to clear out the warehouses. The only way to do that is through heavy discounting.
Which crushes your gross margins and destroys the premium brand equity you spent years building. Nobody wants to pay $160 for a premium shoe if they know they can get it for $80 at an outlet store in 3 months.
Exactly. And exactly the opposite is happening here. The fact that Deckers grew revenue by nearly 6% while simultaneously reducing their inventory shows supreme supply chain discipline.
They're matching supply to demand perfectly, which means they're selling at full price.
And that full price selling is what drives the 56.4% gross margin,
Which generates the free cash flow.
which funds the $338 million in share buybacks. It is a highly functioning financial ecosystem.
Absolutely, which is exactly what you need if you want to fund a $4.7 billion buyback authorization.
Right. But management, despite being confident enough to buy their own stock aggressively, loaded their forward-looking guidance with macroeconomic caveats. If you are analyzing this stock, you really need to read the fine print in the Outlook and forward-looking statement sections.
Those sections are always eliminating because they tell you exactly what keeps the executive team awake at night. They outline the variables that could derail this highly functioning ecosystem.
And for Deckers, the list is very specific. The guidance assumes no meaningful changes to the macroeconomic or geopolitical landscape.
Standard disclaimer, but important.
Right. And the specific risks they cited include escalating global conflicts, shifts in consumer confidence and discretionary spending, inflationary pressures, foreign currency exchange rate fluctuations, and supply chain disruptions.
All the heavy hitters.
Yeah. And there's one highly specific note regarding trade. The outlook does not assume the collection of refunds for tariffs previously paid, and global trade policy and tariffs remain a stated risk.
That's a big one.
I have to ask, are these risks just standard corporate boilerplate that the legal team forces them to include? Or is a company like Deckers uniquely exposed right now?
Well, it's always a mix of legal protection, but you have to take these specific risks seriously because of the nature of their business. Let's break down why these macro factors matter so much for a lifestyle footwear brand.
Okay.
Inflation and dips in consumer discretionary spending are the mortal enemies of premium shoes. A $160 pair of HOKAs or a $150 pair of UGGs is a highly discretionary purchase.
Yeah, no one strictly needs a new pair of UGGs.
Exactly. If inflation squeezes a consumer's wallet, if rent, groceries, and gas take up more of their paycheck, premium footwear is one of the first purchases they delay.
You can absolutely make your old running shoes last another 200 miles if your grocery bill goes up 15%.
Precisely the danger. And on the operational side, foreign currency exchange fluctuations are a massive headwind when your international business is surging.
Because they're making money in other currencies.
Right. If the US dollar is exceptionally strong, the revenue Deckers generates in euros, yen, or pounds translates to fewer actual dollars when brought back to the United States.
The report even noted that on a constant currency basis, net sales increased 4.8% compared to the reported 5.7%.
So currency actually helped them slightly this quarter.
But it's a variable that can swing violently the other way and wipe out top-line gains.
Exactly.
And what about the tariffs? What's the strategic takeaway from that specific note regarding not assuming refunds for tariffs previously paid? I mean, they are relying heavily on global supply chains.
That note tells us they are playing it very conservative with their guidance. Footwear manufacturing is highly globalized, and supply chains are incredibly sensitive to international trade policies. Tariffs directly hit the cost of goods sold.
So, by explicitly stating they aren't baking tariff refunds into their guidance, management is basically saying, we are giving you a floor based only on the operational metrics we can control.
Right. They aren't artificially padding their EPS estimates with potential government refunds that may or may not ever materialize.
So, synthesizing everything we've covered today in this deep dive, you are looking at a deeply complex but highly functional quarter.
Very much so.
You have a historic Q1 surpassing $1 billion in revenue for the first time. You have HOK driving the top line with steady 7.7% growth, transitioning into a sustainable marathon pace while UGG stays consistent.
Yep.
We're seeing a massive strategic pivot toward direct-to-consumer channels in international markets, which is successfully pushing gross margins up to 56.4%.
But that DTC shift is undeniably expensive. It requires building your own infrastructure, which is driving SG&A up significantly and putting a squeeze on operating income.
Right. But they are countering that operational squeeze with an incredibly aggressive capital allocation strategy. They bought back $338 million in stock this quarter alone, and they're baking an assumption that 80% of their free cash flow will go toward buybacks into their raised EPS guidance of 7.35 to 7.50.
They're manipulating the denominator to deliver value to the shareholder.
Exactly. And they're doing all of this from a position of absolute financial strength, zero debt, falling inventory, and $1.6 billion in cash.
When you put all those pieces together, the financial health of the company is undeniably robust. That pristine balance sheet acts as a massive shock absorber.
It really does.
It protects them against those macroeconomic risks we discussed.
Yeah.
Inflation, the currency fluctuations, the tariffs. They have a deep war chest to weather global storms that might easily capsize heavily leveraged competitors in the retail space.
Which leaves me with a final, slightly provocative thought for you to chew on as you analyze this company's future. We've seen the mechanics of this quarter. We know Deckers has zero debt. We know they have $1.6 billion in cash sitting in the bank right now, and a staggering $4.7 billion authorized for share buyback.
A lot of capital.
But with HOKA currently carrying the team on its back and UGG settling into the mid-single digits, you have to wonder what's stopping management from using that massive cash war chest to acquire a third major lifestyle brand.
Well, that's an interesting angle.
Right. Why just buy your own stock when you clearly have the operational playbook, the DTC infrastructure, and the supply chain discipline to scale a niche brand into a global powerhouse? It's something to watch closely as that cash pile continues to grow.
It is the ultimate capital allocation question for a company generating this much free cash flow, and it will likely define their next 5 years.
And that is the kind of strategic question we love digging into. If you want to keep peeling back the layers on earnings reports exactly like this one, make sure you hit follow. We're here delivering daily, no nonsense earnings coverage to help you cut through the noise and understand the mechanics driving the market. We'll catch you on the next deep dive.